Welcome to Gold Bank Insider.
Good to be here. Thanks for having me.
We are looking at a very specific set of updates today. We're focusing entirely on Riversgold,
Yeah.
ticker RGL, and the news coming out of their Kalgoorlie Gold Project.
Right. Specifically the northern zone.
Exactly,
Yeah.
the northern zone. And I want to set the ground rules for this discussion right off the bat. We are not talking about the spot price of gold today. We aren't talking about interest rates or what the Federal Reserve is doing.
Yeah, this is a very different kind of story.
It is. This is a story about the actual mechanics of the industry. It's about drilling numbers, it's about government paperwork, and how those two things, execution and permitting, move gold equities even when the bullion price sits perfectly still.
I think that's the right way to frame it.
Huh.
Our mission here is to really examine the timeline and the execution details that Riversgold has put on the table.
Mhm.
We need to look at the headline facts, identify the winners in this specific context, and then, and this is crucial, we need to look at the losers.
The losers.
Yes, specifically regarding capital rotation.
We are going to spend a good chunk of time on that concept of capital rotation later because it's vital, especially for our UK audience.
Oh, absolutely. If you are sitting in the UK trading these names, you have to understand flow rotation. You need to understand liquidity changes because when this kind of execution news drops, money moves. And if you aren't watching the flow, you are missing the actual engine driving these share prices.
Let's start with the headline, the Northern Zone update from Riversgold. We have some hard numbers to work with here.
We do. And numbers are always better than vague adjectives.
Definitely. So they have completed 31 new shallow drill holes,
31 holes.
totaling 2,013 meters. This is at the northern zone within that Kalgoorlie Gold Project. Now, I want to pause on the math for a second there. 2,013 meters divided by 31 holes.
It averages out to roughly 65 meters per hole.
65 meters. In the world of geology, that is barely scratching the surface.
It is very shallow. But you have to understand why the word shallow is a specific economic term in this industry, rather than just a measurement of distance.
Break that down. Why does 65 meters matter more than, say, a 500-meter drill hole?
Because of the cost of extraction.
Hmm.
When you are drilling to just 65 meters, you are effectively defining an open-pit resource. You are looking for oxide gold.
Oxide gold. Right.
Yet near the surface, the rock has been weathered by oxygen and water over millions of years. It becomes softer. It is much easier to break apart. Often you can just dig it out with an excavator without even needing to blast it with explosives.
This is what the industry calls free dig,
Exactly. Free dig.
which means it is drastically cheaper to mine.
Much, much cheaper. If you are drilling down to 600 or 800 meters, you're looking for hard rock, sulfide gold. To get that out, you need to sink a shaft or drive a decline tunnel. You are talking about tens of millions of dollars in infrastructure just to reach the ore body.
But at 65 meters,
65 meters, you are talking about stripping off the topsoil and trucking the dirt straight to a mill.
so when the headline says shallow drill holes, it is really signaling low capital expenditure to the market.
Precisely. It signals a shorter timeline to cash flow and a much lower barrier to entry. That is why the market pays such close attention to these shallow programs. Investors aren't looking for a science project here. They are looking for a quarry.
And along with that drilling, we have the sampling data. They have submitted 1,475 samples for assay.
That is a substantial volume of samples for a 2,000-meter program.
What does that tell us about their approach on the ground?
It suggests they are sampling very tight intervals. They aren't just picking out the rocks that look visually promising. They're sampling continuously down the hole. They want to build a highly robust, rigorous data set.
Let's talk about the lab process for a moment, because I think investors often assume you just drill a hole, look at the core, and immediately know if you struck it rich.
Oh, if only it were that simple.
You have to bag these samples up, label them, ship them off to a certified laboratory, and then the waiting game begins.
The wait is always the hardest part for the market. These labs in Western Australia are often heavily backed up. You are in a queue behind basically every other explorer in Kalgoorlie. The rocks get crushed, pulverized, and then they are subjected to chemical analysis, usually fire assay.
Fire assay, that is the traditional method, right?
It is the absolute industry standard. You literally melt the rock to separate the gold from the waste. It takes time.
And what is the timeline Riversgold has given us for these results?
They stated results are expected in batches over the coming weeks.
Coming weeks. That is the phrase that really jumps out. It sets a clock ticking for the market.
It does. It moves the company from a quiet period of just working in the dirt into a period of active news flow. And notice they specifically said batches.
So we aren't going to get one giant, overwhelming data dump 2 months from now.
Unlikely. We will probably see a steady drip feed of news, maybe holes 1 through 5 first, then holes 6 through 10 a week later. This keeps the market engaged, it keeps the liquidity alive and the stock trading.
But this update isn't just about the drill bit, is it? There is a second pillar here.
There is, and you could argue this second pillar is actually more critical for the structural value of the company than the gold itself.
You are talking at the permitting side.
The mining lease application, M25389.
Now, to the average person, M25389 just sounds like a license plate number. But in Western Australia, that designation means everything.
It is the literal difference between having an expensive hobby and having a viable business.
The update we got is that all objections have been resolved.
That is the major hurdle cleared.
Let's unpack what an objection actually means in this specific context. We aren't just talking about a local resident complaining about truck noise.
No, not at all. In Western Australia, the Mining Act allows various legal parties to object to the granting of a mining lease. This could be environmental groups, it could be native title claimants, it could be pastoralists, the farmers who hold the surface rights where you want to dig.
Right.
It could even be other mining companies who think your lease boundary overlaps with their access roads or infrastructure.
It sounds like a total legal minefield.
It absolutely is.
Yeah.
And any one of those objections can wind up sitting in the warden's court. That is a specialized court system in WA just for mining disputes. If you get bogged down in the warden's court, you can be delayed for months, sometimes years. You burn your cash on lawyers instead of drilling.
So when Riversgold publicly states all objections have been resolved, they're saying they have successfully navigated that legal minefield.
Correct. They have negotiated with the objectors. They have reached formal agreements. The path is now legally clear.
And the next step for them.
Now it is purely an administrative process. They are working directly with the Western Australian regulator to get the lease formally granted.
And again, we see that exact same phrase in the release, coming weeks.
Right. So look at the convergence happening here. You have two parallel timelines hitting the finish line at the exact same moment. You have the assay results coming back from the lab, which will tell you how much gold is actually there. And you have the mining lease coming from the regulator, which gives you the legal right to dig it up.
It is almost like a pincer movement on value creation.
That is a perfect way to put it.
And while all this paperwork and lab analysis is happening, they're still actively working on the ground.
Yes, the operational progress is continuing unabated. Mine planning and environmental baseline work are progressing simultaneously.
This involves their development partner, correct?
It does, and we will discuss the partner dynamic in a moment because it strongly validates the project. But the key takeaway right now is that they aren't waiting for the piece of paper to arrive before they start planning the mine. They are executing in parallel to save time.
So let's take a step back and connect the dots. What does this all actually mean? Why does this specific update matter to the market right now?
If you look at the mechanics, this is a pure execution story.
Execution.
Yes. In the junior mining space, you essentially have promoters and you have executors. Promoters spend their time talking about how big the gold nugget might potentially be. Executors focus purely on the rigid process of getting it out of the ground.
And this update is fundamentally about process.
Entirely about process. Think about the physical mechanism of those drill results. What do they actually accomplish?
They tell you where the gold is located.
True, but more importantly, they tell you where the gold isn't. They tighten up the near-surface mine plan. If you are going to dig an open pit, you need to know exactly where the walls of that pit should sit. You do not want to dig up and transport waste rock if you can avoid it. These 31 shallow holes are designed to perfectly define the geometry of the ore body.
Which improves the underlying economics.
Drastically. It lowers the strip ratio. The strip ratio is the volume of waste dirt you have to move just to get to the profitable ore.
And what about the permitting side of the equation?
That is about risk reduction. Pure and simple.
Explain that relationship between risk and market value.
The market aggressively discounts risk. If there is a 50% chance you won't get your mining permit due to court battles, your stock trades at a 50% discount, roughly speaking. Every single time you permanently remove a risk factor, that discount unwinds.
So resolving those legal objections removes a massive chunk of uncertainty from the valuation.
It changes the fundamental question from if this mine happens to when this mine happens.
And that shift usually correlates with a repricing of the stock.
That is the core logic. If the lease is granted right on schedule, and if the lab results show continuous gold grades, your financing risks decrease. your schedule risks decrease. The project transforms into a real, tangible asset rather than just a speculative bet on a map.
So let's get into the specific winners here. Who directly benefits from this news? Obviously, Riversgold.
Riversgold is the primary winner, ticker RGL.
The core narrative for them is clearly de-risking.
De-risking is a bit of an industry buzzword, but it is highly accurate here. Why do they win today? Because the drilling, the sampling, and the mine approval work streams are all tangibly active. That activity provides a floor of support for the valuation.
It is moving from a concept closer to a reality.
Exactly. At the end of the day, investors pay for probability. This increases the probability of cash flow.
Now, let's talk about that development partner we mentioned earlier, Mega Resources.
Mega Resources, right.
They aren't the ones issuing the press release today, but they are undoubtedly watching these developments very closely.
They absolutely are. Think about it from their strategic perspective. They are looking for a clear pathway to a funded production start. They want to be involved in an operation that is actually generating physical cash.
So as Riversgold advances all this paperwork and completes the physical drilling, Mega's position naturally improves.
The underlying asset they are partnered on becomes substantially more valuable. If these stated timelines hold up, Mega Resources suddenly finds itself attached to a project that is real, fully permitted, and well-defined. That immediately increases the strategic value of their own corporate portfolio.
It basically validates their initial due diligence.
It does. It proves to their shareholders that they picked the right horse to back.
Now, you listed a third group of winners in our notes today, which is Resources WA and DMPE.
The regulatory and assessment bodies in Western Australia.
Why do we list them as winners? It seems a bit odd to include government departments in this context.
It is about relevance and systemic activity. As a project shifts from pure early-stage exploration, which, let's be honest, is just a few geologists out in the bush kicking rocks, to formal approvals and operational readiness, the interaction with these government bodies spikes dramatically.
So they become central to the entire process.
They do. It signals a tangible rise in assessment and compliance work for these entities. For the bureaucracy, this is the regulatory system working exactly as intended. They are the gatekeepers of the resources, and they are now in the active process of opening the gate.
Okay, so those are the clear winners. But the market is a finite place. There is only so much capital and attention to go around.
Attention is, without a doubt, the scarcest currency in the junior mining market.
So let's talk about the losers. And you used a very specific phrase when we were preparing for this, relative losers.
We must be very, very precise here.
Clarify that concept for us.
When we say losers in this specific context, we do not mean these companies are actively losing money today. We do not mean their geology has suddenly failed. We do not mean they are fundamentally bad businesses.
So what exactly are they losing?
They risk losing investor attention. And in the microcap equity space, attention equals liquidity. If nobody is looking at your story, nobody is buying your stock.
And if nobody is buying, the share price just drifts.
It drifts lower on very low volume. It is the classic death by 1,000 cuts for a junior miner.
This brings us to the concept of capital rotation.
Correct. Retail and institutional investors only have a limited amount of speculative capital. They are constantly looking for the exact place where that capital can work the hardest and the fastest.
They are hunting for catalysts.
They are hunting for high-velocity news. If Riversgold is out there shouting about imminent mining leases and steady drill results, and your company is completely quiet, the fast money leaves you to go buy Riversgold.
So let's name names here. Who is sitting in the shadow of this update? First on your list is Horizon Minerals.
Horizon Minerals. Now, for context, they hold major gold projects in the exact same region, the Kalgoorlie region, specifically the Binduli and Burara areas.
So they are close neighbors?
They're geographic neighbors, but more importantly, they sit in the exact same mental bucket for investors.
The local gold exposure bucket.
Exactly. If I am an investor sitting in London and I decide I want exposure to the Kalgoorlie gold fields, I might have Horizon and Riversgold sitting right next to each other on my trading watch list.
And if Riversgold suddenly creates a compelling catalyst,
you sell your Horizon shares to buy Riversgold. That is the fundamental risk for Horizon here. If Riversgold accelerates its permitting and its drill catalysts, that speculative capital rotates away from Horizon toward the company with a dense news flow.
It is all about momentum.
It is entirely about momentum. The market absolutely hates a vacuum. Horizon might be doing fantastic technical work behind the scenes, but if they aren't actively talking about it right now, they lose the narrative battle.
Next on the list of relative losers is Ora Banda Mining.
Ora Banda. They are a very solid operator.
Yeah.
Their Davyhurst operation is located near the broader Kalgoorlie Gold Fields.
What is the specific risk there? Because they are actually a producing company, aren't they?
They are. But the risk here is purely market psychology. In a risk-on tape, that market environment where investors really want to gamble a bit on the faster-moving juniors companies with imminent, punchy catalysts can completely overshadow the steady, reliable operators.
It is the shiny object syndrome.
Precisely. The market trades heavily on headlines and timelines. If Ora Banda is just chugging along, doing good steady work but without a flashy, immediate headline, they can easily be left in the shadow of Riversgold's high-velocity news.
So the operational stability of Ora Banda actually works against them in a speculative fervor.
In the short term, yes. Steady is perceived as boring. Explosive is what draws the heavy trading volume.
Finally, we have Matza Resources.
Matza Resources, they hold the Lake Carey Gold Project. Again, this is a Goldfields asset. They have existing mines and existing prospects.
What is the core problem for them today?
The core problem is the lack of a punchy, near-term catalyst stack.
Catalyst stack. I really like that term. Break that down for the audience.
A catalyst stack is when a management team has multiple distinct pieces of market-moving news lined up like planes on a runway. Riversgold has drilling results, they have permitting updates, they have formal lease grants, all neatly stacked up in the coming weeks.
It creates a very dense news environment.
It does. It gives investors multiple reasons to buy and hold. If Matza doesn't have that same density of upcoming news, they face relative underperformance.
Because the market is chasing funding clarity.
They're chasing funding clarity, and they are chasing production proximity. If a company can't demonstrate those things clearly right now, the money naturally drifts to someone who can.
This brings us directly to our audience, specifically our UK audience. We have a lot of people listening in London, in Manchester, Edinburgh. Why does all this specific Australian corporate maneuvering matter to a retail trader or fund manager sitting in the UK?
It matters deeply because of flow rotation.
Let's go a bit deeper into that. Why do UK traders even bother looking at the ASX?
Several structural reasons. First is the time zone advantage. The ASX closes before the London market even opens. You can wake up, see exactly what happened in Australia, analyze the flow, and position yourself accordingly. It acts as a leading indicator for resource equities.
And the risk profile of these stocks?
Australian junior miners are often seen as high beta plays. They move very fast. They are highly responsive to news.
So what is your specific advice for the UK trader watching this Riversgold story unfold?
You need to watch very carefully for rotation into these near-term catalyst names like Riversgold.
You mean actively watch for the money leaving the quiet stocks?
Yes. The direct trade-off is movement away from the slower news peers. And that creates a very specific mechanical risk that you need to be acutely aware of. Liquidity risk.
Explain the mechanics of that liquidity risk.
We warned about those loser stocks, Horizon, Matza, or Abanda. As liquidity thins out because all the daily trading volume is moved over to Riversgold, the spreads on those quieter stocks may widen notably.
The spread being the numerical difference between what you can buy a share for and what you can sell it for.
Exactly. The bid-ask spread. If everyone leaves the room to go look at Riversgold, the bid-ask spread on Matza or Horizon gets wider. It becomes mathematically more expensive to get into or out of a position.
So you could easily get trapped in a position.
You could definitely see much choppier trading. You might see sudden price gaps down that aren't based on any bad news, but simply on a total lack of buyers. A stock could drop 5% just because one retail investor sold a block and there was no bid there to catch it.
That is a very dangerous environment for passive capital.
It is. That is exactly why you have to follow the volume. You have to fish where the fish are.
And we need to be crystal clear about what is actually driving this movement in Riversgold.
We do. We need to clarify the beta here. These specific names, Riversgold, Horizon, or Abanda, they are currently moving based on permits. They are moving based on assay labs. They are moving based on financing news.
They're not moving just because the broader gold price went up $5 overnight.
Correct. This is pure idiosyncratic risk. It is company-specific execution. While the macro gold price provides the general backdrop, the actual driver of the share price right now is the paperwork and the drill bit.
Does this activity affect the UK majors? The big diversified miners listed on the LSE?
Not directly, no. This won't move the needle for a giant like Anglo American or Rio Tinto, But there is a subtle indirect spillover effect.
How so?
It subtly shifts the overall risk appetite for the mining sector. When the juniors start successfully executing, when permits actually get granted by the government, it brings a bit of necessary optimism to the whole resource ecosystem. It lubricates the machinery of the market.
So putting it all together, what is the allocation strategy here? If you are a trader sitting in the UK looking at this data, what do you actually do?
The opportunity is highly tactical. UK investors might strongly consider trimming their positions in the laggards, those specific companies, without the catalyst stack until those companies can present clear, upcoming catalysts of their own.
You are basically suggesting they park their capital where the action is.
Or at the very least, don't leave your capital stranded in a stock where the volume is drying up.
It really is a massive game of musical chairs.
It is. And you do not want to be the one sitting on a stock that produces absolutely no news for 3 straight months while the rest of the sector moves on and generates returns. The opportunity cost is simply too high.
Let's bring this home. Let's summarize what we have unpacked today.
The core update is simple but powerful. Riversgold drilling is complete. 2,013 meters in the ground, targeting shallow oxide material.
And the regulatory side.
The lease objections are fully resolved. The legal path to the official grant is clear.
And the broader market dynamic.
Capital is actively rotating. It is rotating toward de-risked timelines. It is moving toward the management teams that can definitively answer the question, when?
And that leaves us with a final thought for today. Something for you, the listener, to mull over as you look at your own portfolio.
It really raises a fundamental question about the nature of value in this specific market. In the current environment, ask yourself, is a local permit approval worth more to a stock price than a marginal increase in the price of gold itself?
That is the ultimate question. Because a company can control the permit process, or at least they can fight for it in court, but the gold price, you are completely at the mercy of the world.
Precisely. Execution is the only lever a management team can actually pull.
We will leave it there for today. Thank you for joining us on Gold Bank Insider.
Thanks for having me. Take care.